G'day and welcome to this week's video. My name is Robert Gowdy and I was recently asked online how would I put together a ETF, an exchange traded fund portfolio for $100,000. And the brief was they wanted great diversification, they wanted dividends and franking credits, and they also wanted growth. So they really want everything. But when we invest into the markets, the one thing I can guarantee they'll get, in addition to all those, is volatility, because we're talking, if we want growth, we need to invest into the market. So let me go through what I would recommend, and please remember this is general advice only. So where I would start is, I did a video recently on why I would not look to invest in the ASX 200, and the main reason there is if we invest into the ASX 200 index, we know that half of that money, nearly 50% or thereabouts, is going to be invested into resources and also financials. So resources will be made up of a lot of resources companies, but three really big ones. So BHP, Rio and Fortescue Metals. And when it comes to financials, we're going to get four really big banks. That'll be, we know the banks, the big four. So I want to invest outside of that. So I would recommend the code is MVE, that is, and I'll bring up the graph. I'll get my clever editor to do that. So that'll be in the VanEck S&P ASX Mid-Cap ETF, and that is MVE. So what that'll give us exposure to is the, in terms of the market, the ASX 100, you're going to get the top 50 through to 100, that is the mid caps. Now, because one of the briefs wanted some high dividends and wanted franking credits, I don't invest that way, but I'm going to put 20% into the VanEck one and then 20% into Russell Investments High Dividend Australian ETF, and that is RDV. So 40% is going to go to Australian shares, and that fits the brief, but I'm not being too generous there to focus on high dividends and frank credits only. I think it's a blunt tool in terms of overall investment viewpoint. So it's all about diversification. So to make sure we get diversification, I've then recommended that we go overseas and recommended IJH, which it's LGH, the iShares S&P Mid-Cap ETF. So again, like the VanEck one, you're going to get in, not those mega caps, we'll cover them off in a moment, but you're going to get other smaller businesses that can potentially grow into larger businesses. I don't want to forget that space. And then I'm going to use one of our favourites, which is the it's the Vanguard, the MSCI, it's VGS. The Vanguard Global Share Fund, and that's tracking the MSCI index, and that's going to, 70% of that fund is going to be invested into America and some of the biggest companies that we all know and love and use their products on a daily basis. I'm recording this on my iPhone, so Apple is there. I'm using Microsoft behind on the screens there all the time. So all these amazing businesses, Google, Meta, MasterCard, Visa, the list goes on. So I'm recommending 20% go into that space. And then I'm wanting to get a little bit pointed. I want to add some flavour in there to hit some sectors that I believe that are going to be just pushed by tailwinds, pushing certain sectors along. And that is, the first one is the BetaShares Global Sustainability Leaders ETF. And that one is ETHI, and 10% will go into there, and also IXJ, which is the iShares Global Healthcare Fund. So obviously the sustainability is all about climate change. There are tens of billions of dollars being directed into this space, and has done, and there will be many billions invested to come. That is a space, a theme that we want exposure to. And healthcare, as the baby boomers are going through, people need more healthcare, and that'll give us exposure to a lot of pharmaceuticals and so on. So 10% goes into there, and the last spot I'm recommending is the Vanguard All World Excluding US Shares Index, and that's VEU. 10% goes into there. and we'll bring up the graph so you can see what I've recommended, and that will give us exposure to the rest of the world, because the US and the size of their businesses dominate substantially, and I believe there is potentially at this stage in the cycle better value elsewhere. Now, if we have a look at the investment performance chart for the last 6 months only, now it's a short term, I'm not a short term investor, but you can see that the returns are pretty well 10% and above for the last 6 months. The market has a tremendous run in recent times. So therefore, would I invest $100,000 personally in one hit right now? No, I wouldn't. I would gradually invest it over a matter of months or potentially over a year. So you might say, well, let's split up this $100,000 into 10,000 increments and then split that 10 grand evenly across those percentages that I mentioned. So that's how I do it. I'd be very careful. The reason why I'm recommending staging, dollar cost averaging, is that I know that the NASDAQ has done over 30% as of the day of recording this. That is a huge result. It's highly unlikely there's going to be another 30% ahead of us over the next 12 months. So just a little bit of cautious on when you buy. There is always a correction or a crash just around the corner. The problem is I don't know when it's going to arrive, but they always do. Thanks for listening, and catch you next week. Cheers.